Welcome back to Investing Talk Podcast.
Today we're looking at MP Materials, and I really want to frame this correctly right out of the gate. We're not just talking about a mining company here. We are looking at a critical national security asset. It's the only player of its kind in the United States, and it represents this massive transition from just, digging dirt out of the ground to actually powering the future of defense and technology.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps us out with the algorithm. So let's unpack this a bit, because rare earths is one of those buzzwords we hear constantly,
Right.
usually read alongside geopolitics in China. But for the average investor tuning in, it can just sound like a high school chemistry class. Why should you, the listener, actually care about this?
You should care because your entire modern life runs on this stuff. I mean, the smartphone in your pocket, the EV you're thinking about buying, even the guidance systems in defense tech like a Tomahawk missile. They all rely on these highly specific permanent magnets made from neodymium and praseodymium.
Which are incredibly hard to process at scale.
Exactly. And right now, China essentially has a stranglehold on that entire processing chain. But MP Materials operates the Mountain Pass mine out in California. That is the only scaled rare earth mining and processing site in all of North America.
So in a world where supply chain sovereignty is basically becoming the central theme of the decade,
It really is.
MP is sitting right at the center of the chessboard. Essentially, if trade relations go south, this stock isn't just an equity play. It is practically an insurance policy for the entire U.S. tech sector.
That's a great way to put it. It's the ultimate hedge against a geopolitical blackout.
Okay, let's look at the books, because narratives are fantastic, and I do love a good spy thriller, supply chain backstory, but at the end of the day, I prefer cash flow.
Fair enough. And this is where the financial story actually gets fascinating, because we're witnessing a massive shift in their whole business model. For years, they were just a mining operation.
Right. Dig up the ore, concentrate it, ship it out.
Exactly. And honestly, that's a low-margin, highly cyclical commodity business. But they are transforming into a vertically integrated producer. So they aren't just shipping the raw dirt anymore. They are refining it and manufacturing the actual finished magnets right here on American soil.
And we are finally starting to see the proof of that in the actual numbers. Because looking at the segment revenue, that magnetics line item is actually showing a pulse now.
Oh, it's way more than a pulse. It's basically the birth of a new company.
Yeah.
In the most recent quarter, the magnetics segment revenue hit $21.9 million.
Which, to some of you listening, 22 million might sound like a rounding error for a major public company.
Right, but context is everything here. In 2024, that number was virtually zero. The segment barely existed. So you're watching this vertical transition happen in real time.
And looking at the analyst consensus, they're projecting this isn't just a flash in the pan. They're pointing to a 59% annual revenue growth rate.
Yeah.
Which is, that's aggressive. You usually see that kind of growth in software as a service startups, not heavy industrial materials.
It is aggressive, but it's backed by actual paper. They aren't just building these facilities and hoping someone buys the magnets. They have the buyers lined up. We have to talk about the major contracts because that's what validates the whole model.
Right, the elephant in the room being Apple.
Exactly. They secured a $500 million long-term supply agreement with Apple, specifically for recycled magnets. And look, Apple doesn't just buy components from anyone.
No, their qualification process is notoriously brutal.
Brutal. If MP can meet Apple's standards for purity, for scale, for ESG compliance, it effectively serves as a massive stamp of approval to the rest of the consumer electronics market.
But perhaps even more significant for the long-term competitive moat is the Department of Defense deal. $400 million from the DoD.
That deal changes everything. It puts an absolute floor under the company. It sends a very clear signal that the United States government simply cannot afford to let this operation fail. It transitions them from a speculative mining stock into a core piece of national defense infrastructure.
I hear that, but I have to play the skeptic role here for a minute.
I knew it was coming.
Someone has to look at the bottom line. Because despite the flashy Apple contracts and these massive growth projections, the current reality is pretty stark. They are loss-making. They're sitting on a negative net margin right now.
They are.
And if you look at the free cash flow over the trailing 12 months, they are in the hole by $294.9 million. That is a heavy cash burn.
They're burning cash, yes, but you have to contextualize why they're burning it. This isn't money being set on fire for, bloated executive perks or failed marketing campaigns. They are physically building massive, heavy infrastructure.
And new facilities.
Right. The Fort Worth facility, the heavy manufacturing capabilities, that is heavy capital expenditure. And if you actually look at the balance sheet supporting that burn, it is an absolute fortress.
It is surprisingly healthy for a company bleeding that much free cash, I'll give you that.
Incredibly healthy. Their current ratio is 8.05.
Let's just pause on that metric for a second for everyone listening. A current ratio of 8.05 is absurdly high for an industrial player. It essentially means that for every single dollar of debt they have coming due in the next year, they have $8 of liquid assets sitting there ready to cover it.
Exactly. And their quick ratio, which is even more stringent, is 7.51. In the heavy materials world, those numbers are almost astronomical. It shows massive liquidity.
And the debt to equity.
Very manageable. It's sitting at 0.47. So yes, the cash flow is negative right now, but they have this massive runway to actually execute their strategy without drowning in high interest debt. They do not need to go hat in hand to the capital markets anytime soon.
So the argument is that this cash burn is a deliberate, fully funded strategic investment rather than an operational failure.
Exactly. That investment is what's building the China hedge. That is their ultimate competitive moat. MP is the sole U.S. operator shielding the domestic market from those China-dominated competitors.
And having the U.S. government backing you serves as a nearly insurmountable barrier to entry for anyone else trying to compete.
Right, because you can't just spin up a startup to do this. You can't just replicate a permitted mine, a complex processing facility, and lock in a DoD contract overnight.
It takes a decade just to get the environmental permits to dig a hole in California.
Exactly. And MP has already done the hard part. They have the Fort Worth facility coming online almost as we speak, and they have their massive 10X facility targeted for 2028. The physical infrastructure to dominate this space is literally being built right now.
We'll pivot to the charts, because I want to see if a price action actually reflects this fortress narrative. Sometimes the market completely ignores a good balance sheet if the cash isn't flowing yet.
In this case, the market is definitely paying attention. The stock has been on an absolute tear. Over the last year, it has rallied 127.7%.
Yeah, looking at the technicals, it's been trading in a pretty well-defined range recently, roughly between $58 and $67. And as of mid-February 2026, we're seeing it hover right around $58.03. It gained about 1.9% recently, but it feels like it's taking a bit of a breather after that monster run-up.
Taking a breather is healthy, and critically, it is holding the broader trend. If you pull back and look at the moving averages, the stock is sitting right near that 50-day moving average, which is at $59.66.
It's actually just dipping slightly below that 50-day line right now at 58. Usually, technical traders get a little antsy when a stock loses that 50-day support.
In the very short term, sure. But look at the 200-day moving average. That's down at $64.85. Wait, let me correct that. The current price is $58. The 200-day is $64.85. The key here is that despite this recent consolidation, the broader structure is intact. We're seeing a pattern of higher highs and developing bullish momentum over the macro time frame.
Let's talk about the momentum specifically. Where is the RSI sitting?
The relative strength index is hovering right around 63.3.
Okay, so that's upper neutral territory.
Exactly. It implies that the trend strength is absolutely there, the buyers are present, but it isn't dangerously overbought yet. It's not screaming for a massive pullback like it would if it were printing above 75 or 80. It suggests there's still gas in the tank.
One anomaly that really stood out to me in the data was the volume. We saw massive volatility back in late 2025, right? Huge rapid swings between $70 and $90. But recently, the volume has just dried up. On these recent updates, trading volume was actually 67% below average. Now, traditionally, if you see low volume on a rally, that's a warning sign. It usually suggests a lack of conviction from the big money.
I actually interpret that completely differently in this context. I see that as coiled momentum.
How so?
When you have an asset that has already rallied over 120% and then it starts consolidating on extremely low volume, it often indicates seller exhaustion. Everyone who wanted to take their profits off the table has already done it. The retail tourists have moved on to the next shiny thing. So now, the stock is just tightly coiled, waiting for a fundamental catalyst to drive that next leg higher.
So you think it's just the calm before the next storm?
I do. The market is holding its breath for the next major news cycle.
Well,
Well,
what is the street saying? Let's look at the sentiment, because the analysts must be tracking this coiled momentum too.
oh, the street is definitely waking up to the story. The broader consensus right now is sitting firmly at moderate buy to buy.
And the price targets are finally moving up to catch reality. We're seeing average targets in that $74.64 to $78.91 range. That is a massive jump considering where this was trading a year ago.
It is, but it reflects the execution of that vertical integration thesis we talked about. You have the heavy hitters stepping up now. Goldman Sachs has a buy rating on it with over 30% upside projected. We've seen significant upgrades from Morgan Stanley targeting 71, BMO targeting 75, plus Deutsche Bank and William Blair all piling in.
What's the core narrative driving those institutional upgrades? Is it just the potential for an earnings beat next quarter?
No, institutions aren't looking quarter to quarter here. They're buying the 10x plan. The market loves a tangible growth story, and MP is laying out a clear roadmap to scale their magnet production by 10 times over the next few years. But honestly, the real confidence booster that got the street on board was that Department of Defense equity investment.
We really need to pause on that because that is exceptionally rare. Usually when the government wants to support an industry, they hand out a grant or they offer a low-interest loan, but direct equity investment.
It's a game changer. It implies an extreme level of structural alignment. The DoD isn't just treating them like a vendor anymore. They view MP almost as a strategic partner.
They bought a seat at the table.
Exactly. And that signals to the broader market that the existential risk of this company failing is practically zero. The U.S. government is now literally a shareholder. They have a vested interest in the equity appreciating.
Speaking of governments and macro alignment, we have to address the speculative rumors floating around. There's been a lot of chatter regarding Trump's proposed $550 billion Japan deal.
Right. Now, we have to preface that this is entirely unconfirmed rumor right now.
Of course.
But the speculation is that this massive bilateral deal could heavily spotlight rare earth stocks, specifically for shared energy and mineral supply chain projects.
And we already know Japan has pledged $36 billion targeting strategic minerals. If MP Materials can tap into that Japanese capital or integrate into those allied supply chains, that is a monumental tailwind. Because Japan is arguably just as desperate to put their reliance on China as the U.S. is.
Precisely. Japan is the other major high-tech manufacturing economy that is uniquely vulnerable to a supply chain shock here. MP is the natural allied partner for them.
Okay, all of that sounds incredibly bullish. But as the designated skeptic, I have to point out the insider flow. The chief financial officer sold 38,146 shares back on December 9th.
I saw that.
When I see the CFO unloading that kind of volume, my radar goes off. That is the one person who knows the actual state of the books better than anyone else on earth.
It's absolutely a valid data point, and you always want to track insider flow. But you really have to weigh a standard insider sale against the overwhelming institutional conviction from players like the DoD.
Do you think it's just standard profit-taking?
Yes. Executives sell stock for a million mundane reasons. They have a tax bill, they're buying real estate, portfolio diversification. But governments and institutions only invest billions of dollars for one reason: strategic necessity. So, if I'm weighing the signals, I will take the DoD's strategic buy over a single executive scheduled sell any day of the week.
That's a fair counter. But let's take a look at the risks, because there are structural headwinds here that we cannot ignore.
Always the wet blanket.
Hey, someone has to keep us grounded in math, and the math on the valuation is honestly tough to swallow. The price-to-sales ratio right now is 42.14 times.
It's high.
It's nosebleed territory. That is incredibly high compared to any of his mining peers, and it's even rich for a hyper-growth tech stock. You are literally paying $42 for every single dollar of revenue they generate today.
Look, there's no getting around that metric. The stock is expensive. The market has absolutely priced a significant amount of perfection into that premium.
And they are pricing in perfection for a reality that is still years away. If you look at the discounted cash flow models, the projections suggest that free cash flow might not actually turn positive until 2029.
Right, they're projecting about $156 million in positive cash flow by then.
But that means investors have to sit on their hands and wait 3 to 4 years just for the cash burn to stop. A lot can go wrong in 3 years.
That is the timeline you have to accept. You aren't buying this for the present cash flows. You are buying the future monopoly on domestic supply.
But there are macro risks to that monopoly. We just saw the Supreme Court tariff ruling hit the news, which definitely pressured rare earth equities lower across the board. Anything that creates trade anxiety causes volatility here.
It definitely created short-term headwinds. The market hates uncertainty in trade flows.
And then there's the ultimate geopolitical irony at the heart of this entire bull case. The fundamental premium on MP's valuation is built on the tension between the U.S. and China. If by some diplomatic miracle those tensions actually ease and global trade normalizes, the urgent necessity for a completely independent non-China supply chain suddenly evaporates.
That is the paradox of the defense sector.
Peace is literally bad for the stock price.
It is, but if you look at the macroeconomic landscape today, betting on a sudden long-term outbreak of global geopolitical harmony seems like a much riskier bet than betting on continued friction. Supply chain security is a one-way street now. Governments aren't going to unlearn the vulnerabilities they discovered over the last few years.
Time for the verdict. We've covered the pivot to manufacturing, the massive cash burn, the fortress balance sheet, and that nosebleed valuation. Where do you land?
After weighing the projected growth, the sheer size of the competitive moat, against the valuation risks, I am giving MP Materials a highly confident bullish score of 8 out of 10.
An 8 out of 10. That is a very strong conviction score for an asset trading at 42 times sales. Give me the final thesis.
The thesis is that MP is a multi-year structural winner. You have to stop looking at it as a mining play. It is a core technology and defense infrastructure play. The revenue is forecast to grow at 59% annually as they turn these facilities on.
And I suppose if they actually hit that 59% growth rate, that 42 times sales multiple compresses very quickly.
Exactly. The company grows into its valuation. The elevator pitch is incredibly simple. Their vertical integration, backed by DoD funding and validated by Apple contracts, makes them the single viable option for domestic supply chains in electric vehicles and defense tech. They have no equal in the U.S.
And what about the actual intrinsic value?
This is the counterpoint to your valuation concerns. If you look at the discounted cash flow models, assuming they successfully execute this magnet strategy and hit that positive cash flow in 2029, the stock is currently trading at a 65% discount to its true intrinsic value.
So the timeline is key. What is the target horizon for an investor jumping in here?
This is a multi-year hold into at least 2028. You are holding specifically to capture the value of the 10x facility scaling up and coming fully online.
So, to recap, while the current valuation is undeniably expensive on a revenue basis, the structural moat and the government backing make it a unique asset in the market. That's it for today's deep dive on MP. Don't forget to subscribe, like, and comment to support the channel. We'll see you in the next one.